Hey guys, it's Wayne Hillier here from Real Estate Investing Masters. I am very excited to be sharing with you guys today a real life Edmonton real estate case study. We're going to be diving into a deal that was actually purchased just about 1 year ago today, in January of 2024, by one of our mentees in the Real Estate Investing Masters mentorship program. And we helped this investor find this property, analyze it, and what has happened with that property since then is going to blow your mind. The returns that they've received on this are just absolutely phenomenal. And we're going to show you guys how keeping things simple in real estate is really, truly the best way to go about investing in real estate. There's no sense in overcomplicating things. We like to keep things super simple, super basic, and just sticking to the fundamentals of real estate investing. And this is how you win in the long term. And this is how you avoid going bust. So I'm going to pull up this deal right away. I'll give you a little bit of a backstory on it, and then we'll just dive right into the numbers. This deal was purchased, as I said, in January 2024 in Edmonton. One of our mentees in our program saw this and thought, hey, I think this is a really good opportunity because, I could see that Edmonton is going in a positive direction. There's going to be some value increases here pretty soon. But a lot of people were really skeptical at that time. You got to remember, this is 12 months ago. This is before the interest rates started to come down and people were feeling a lot more comfortable with the market. Additionally, with those higher interest rates, at this time, it looks like it was around 6.35%. It was hard to find things that cash flowed. And so everyone's like, I want to invest in this market, but I also want cash flow. And sometimes it's a little bit difficult to get the appreciation you want, but also to get the cash flow that you want. That cash flow is, it's what protects you. So at this time, it was very hard to find cash flowing rental properties in Edmonton because of these higher interest rates. But there was a tremendous opportunity to get into the market before the prices start to go up more. So everybody was anticipating once the interest rates come down, the buyers are going to come back in, the prices are going to go up, but you got to buy it before the interest rates come down in order to get in before the prices go up. You could see the conundrum that everybody was in. But this investor saw this opportunity and said, okay, I just need to find a property that cash flows right now, that the numbers make sense right now so that I can get in at today's price. And then once everybody else jumps in later on, I get all the benefit of that asset appreciation because I already own it, which is just tremendous, like really, really smart investing, really, really smart investing. And that's what we teach. That's what we teach investors is to always make sure that, you're buying in good markets that have high potential for appreciation, but that does not give you the excuse to buy properties that don't work today. And we like to teach people how to buy properties that will profit even if the value of the property doesn't go up. What I mean by that is we're going to buy a rental property that even if the value of the property doesn't go up, it still makes money. And also we want to make sure that it has that cash flow as that protector, as that risk mitigator to make sure that even if the value of the property doesn't go up and we decide to keep this thing for 10 years, that cash flow is what protects us. That cash flow is that cushion that if rents ever go down or interest rates ever go up, we're always going to be safe. Okay, so this property, let's get into the numbers. This property, they were able to get this property for $300,000. They were able to negotiate down on the price a little bit and got a really good price. And they put 20% down, you can see here, $60,000. Now, I'll admit, I did advise this investor, maybe it might be a good idea to put a little bit more money down just to lower that mortgage amount and ultimately lower your mortgage payment, which is going to create a little bit more cash flow because we do want as much cash flow as possible. Now, the investor decided, hey, I understand my risks. I get it, but I only have $60,000. So that's all I'm going to put down. That's completely up to you. It's completely up to you. But, sometimes putting the minimum amount of money down isn't enough. And if you want to get in on a really good opportunity, you might just need to put a little bit more money down to kind of reduce your risks. Okay. This investor decided to go with 80% loan to value or 20% down. The interest rate at that time was 6.35%. Now, they decided to go with a variable rate mortgage because they thought, hey, if interest rates are probably going to be coming down, I would like to get the benefit of that as they start to come down. So they decided, I'm going to go variable rates. And then once those rates start to come down this year, then my mortgage payments are going to change, which is going to increase my cash flow, which was a very smart decision. Because as those rates come down, the mortgage payment comes down, cash flow increases, and it's going to put more money back into your pocket, which is going to reduce your risks on this investment property. So what that did was it created a mortgage payment of $1,493.37. Okay. Property taxes were about $250 a month, and insurance for the property, landlord's insurance, is about $150 a month. So all in all, with the market rent of $2,100, the cash flow at the time of the purchase was $206.63. It's, I'd say, good enough. It wasn't great cash flow. I mean, for the metrics that we use to determine what's a good amount of cash flow, it was right on the line of like the minimum. But it, like I said, putting a little bit more money down probably would have reduced that risk, increased that cash flow a little bit. But this investor was comfortable with the risk, and they were comfortable with this deal moving forward. So $206. It's, tell you what we advised them to do was, at the very least, do not spend this $206. Put that $206 into your reserve fund. So that way, if you ever have any repairs or maintenance or any vacancies, you've got that money set aside so that you're covered. And you don't ever have to pull out of your own pocket. Okay. And they agreed to that. Now, the 5-year projection for this investment with no appreciation, we're just going to say that, like, assuming that this property does not appreciate in value at all, no value increase whatsoever over the next 5 years, you can see here in this green box, with just mortgage pay down and cash flow, the ROI, the return on investment for this property, was going to be about 45%. Again, not terrific numbers, but that's based off of zero appreciation. And that's the way that we like to look at this. We like to know that even if the value of the property doesn't increase, because we have no control over that, it's no guarantees. Even if it doesn't go up in value, we want to make sure that we're still going to make money off of this property. We're still going to make a return on our investment. And 45% over 5 years is not terrible, considering the interest rate was 6.35%. Now, if you look at the 10-year projection here, it looks like 100% ROI. So you double your money in 10 years, even if the value of the property stays the same. I just want to keep reiterating that. We're not chasing appreciation here. We are to an extent, but we want to know that this is still going to work even if it doesn't. Now, since then, that was January of 2024. A lot's changed. If you've been following the news, you've probably seen that we've had 5 rate cuts from the Bank of Canada here since then. There was 3 at 0.25% and 2 at 0.5% more recently. And, in January, as I record this, we're expecting another announcement here in about 2 weeks to determine whether the rates are going to be coming down again. So we know a few things. We know that the interest rate for this investor has gone down, which means that their mortgage payment has gone down, which means that their cash flow has gone up. There were some other updates. Market rent has gone up since then as well. So market rent has gone from $2,100 up to $2,200. So that's a $100 increase in cash flow there as well. Additionally, as we expected, when the rates started to come down in 2024, what also grew was the demand for properties, because there were a lot of people sitting on the sideline waiting for those rates to come down. They were waiting for those rates to come down also to allow them to get a higher mortgage to get the house that they wanted. There was a lot of people on the sidelines. And with that demand, what ended up happening was properties just like this started going up in value. This property here, which was purchased for $300,000, is now worth $350,000. A $50,000 profit in just 1 year. We were never we're anticipating it, but we were never banking on any of that. We were banking on what we knew was guaranteed, which was the mortgage paid on and the cash flow, right? What we were not banking on was the appreciation, but it is pretty freaking cool. It is pretty freaking awesome. And that's why we invest in real estate. We invest in it for the long-term growth, but we want to make sure this thing works as a business in the meantime. So $50,000 worth of appreciation was created in equity. Okay. We also got an increase in cash flow. What I'd like to do for you now is I'd like to share with you today's pro forma based off of these changes, so you can see how those return on investments there, those percentages have changed and how much the cash flow has changed. I'm going to switch it over now so you guys can see. And voila. What's happened now, I've changed the number. Obviously, you can see here for the rent to $2,200. I've changed the interest rate down to 4.6%. We hope and anticipate that the interest rates are going to continue to keep going down, which is obviously going to have an effect on these numbers further. But with the new mortgage payment and with the new market rent, the cash flow now monthly is $569.65. Much better than the number that we had before. I feel a lot more confident with that. The cash on cash return for that is somewhere in the range of about 11%, which is phenomenal. Phenomenal. Those are great numbers. If we go down to the return on investment in the bottom right corner in the green, you're going to see that the 45% that we had projected before for 5 years has now gone up to 169% ROI over the next 5 years. Amazing, amazing. Now, you'll also notice that I left this box here empty. I left this market growth estimate per year empty because I am not I'm not banking on any more appreciation. I'm just going to assume that this property is going to stay at $350,000 for the next 5 years, right? And with that, it's 169% ROI. And if we take that into the 10-year projection as well, it is expected to be 267% return on investment on that $62,000 investment. Absolutely phenomenal numbers. You don't get those kind of numbers, investing in anything else. I mean, maybe you can get lucky and strike rich when Bitcoin goes up or gold goes up, but it's not guaranteed. And this is why I want to go back to that thing that I reiterated 4,000 times at the beginning, is we never bank on value growth, value appreciation. We hope for it, but we want to make sure that if we're investing in something, that it's going to profit regardless of what the value of the asset does, right? So yes, the value of the property went up $50,000, but we also know that it was going to make money regardless. And we hope it does, the value of this property continues to go up, we're going to see that 169 and that 267% ROI grow even more. So what did you learn today? Always, always, always invest in rental properties that are going to make money regardless of appreciation, please. Okay, stick to those fundamentals, but buy in a market that has high potential for growth. Okay, find good cash flowing properties with low risk in markets that have high potential for asset growth or asset value growth. Okay, this was a lot of fun. Obviously, this investor is extremely happy with their gains here just in a matter of 12 months, and it's going to continue to keep growing obviously here over the next 5, 10, 15 years until they decide to sell it. If you guys want to see more case studies like this, please let me know below in the comments. We would love to share more. We've got lots of success stories. We have lots of success stories from our students, from the people that we coach and mentor. We'd love to share more with you. I've also got tons of success stories as well from my own portfolio, which I can share over the years of properties that we bought that were, never banked on that appreciation, but we have experienced anywhere from 19 to 21% average ROI on our properties in just mortgage pay down and cash flow every single year. And that's what we like to teach people. We like to teach people how to invest in low risk, high cash flow rental properties that have high potential for growth. Thank you guys so much for tuning in for this. Again, if you guys want to see more of it, put it below in the comments, and we'll see you on the next one.